All right, recording started. Okay, so now let me ask all of you a question till the others join. We still have about 10 or 10, 12 people yet to join. So till then, I would like to ask you guys a question compared to day one, Monday morning. Today's Friday morning. How do you feel about options? As a subject which you were not aware of at all when you came to this class on Monday, and today when you have completed most of the theory and quite a bit of strategies. Alright, that's great to know. Yeah, so Nizamuddin, yes, needs a lot of practice. That's true. Uh, I would, and even if you guys have to take another retake, it's okay because options does need one more retake to have a complete understanding. But those who have understood completely, I don't think there is a need of retake because if you are in the XLT program, that's where all this learning will be again reinforced. We haven't done bull put spread, Deepa. Don't worry. Yeah, Rajiv. See, yes, I do not say that you do won't, all of you won't need or some of you won't need a retake. Options does need a retake. Options class does need a retake, so don't worry about that. That's fine. So and you don't have to hurry up to trade options as an asset class because remember, what is the main thing that we need when we are trading options? What is the first and foremost important thing? Yeah, Harish, correct. Core strategy, absolutely. Demand and supply. So if your demand and supply is incorrect, right, however good you are with options, doesn't matter. You will still lose money. Yeah. So the idea is as you start getting more and more comfortable with supply and demand, the core strategy part, along with that, you'll have to keep on practicing this the theory plus paper trading for options. You will not take trades immediately. It'll probably be the first 3 months will be more like getting used to options, identifying options opportunities, understanding how reward to risk is done, understanding how risk management is done in using options. So once you are comfortable with core strategy, by that time you'll also be comfortable with all the principles and rules of options trading using OTA's strategy, and then you can you'll actually it'll be like a double whammy because you'll be doing well with your core strategy and then options is also getting added as an asset class. Morning, Mr. Suresh. All right. So Rajiv, don't worry. It's perfectly fine as long as you have understood most of the stuff. Okay, the basis, the theory of options. That's more important. Options does take time, so you have to go step by step. Keep on reading, keep on practicing, keep on asking questions in XLTs, and see how this. Even I went through the same process. In fact, for the first 6 months after I did this course in OTA, way back in 2012 or 2013 beginning, when I did this first course, I did not trade options for the next 6 months. The only thing I did was paper trading. So it is need to practice like RS method. Ah, that's not. So don't worry. Yeah, so that Rajiv, the one of the reasons why I took 6 months that time is whatever tools you are seeing today, we did not have those tools. We did not have the IV tool, number one. We did not have options oracle tool to understand completely. So all these calculations was done manually by us. So probably it was a blessing in disguise because once we started doing it manually, the theory started becoming more and more clear. All right. Opstra platform. Okay, we'll make a note of that. Okay, so all of you can also take a look at that. I'll see Anil if time permits, but I am a little bit doubtful about the time because we have quite a bit of stuff to cover. All right, from Define Edge, right? Prem, so all of you can also take a look at that Opstra platform where you can do paper trading. But actually, you don't need. I'll tell you how to do paper trading. It's very easy. Can you explain how you started? Some things you worked and failed. Yeah, I'll tell you towards the end. I'll tell you this, Murugan. Don't worry. You did manually so thorough in theory. Yes, so that's one of the reasons. So did a lot of programming. I'm not sure if I have that. Uh, I don't think I have. It's a new laptop, so all my programs are in the other laptop. Otherwise, I would have shown you. Okay, let me check. Uh, okay. No, I don't have it right now in this. It's there in the other laptop. So maybe next time somewhere. Yeah, so you just have to get this. What do you call XLT IV tool activated. That's it. Just send an email to s3 at onlinetradingacademy.com and that they should do it. Yeah, IV gauge, correct. Rajesh says, hope you'll be connected. Yes, Rajesh, don't worry. It depends on how many emails I get and what am I doing. If I'm taking a class, usually it delays. Uh, but I try to do justice by replying to people, so don't worry. If not, then at least in the XLD sessions, you can ask me whenever my session is there. Sunia, I know you've sent me an email on TCS, but to be really frank, I did not go through it. It's like after the class, I just shut down my computer. Bangalore, I don't know. Any plans for Chennai? Chennai right now does not have a classroom, Murugan. I am not sure whether they are planning any classes in Chennai. Supposed to be in April. I don't think so for Renuka. All right, thank you, Shrikant. See, Hyderabad and Chennai right now there are no classrooms, so I'm not sure if they're going to have any of this. Yeah, I was there in January, right? Or December. Was there in December. MTCs have stopped Sony. Too much to do. Any plans for Pune Center? I doubt. Bombay is in March, Bhavya. And Pune Center, I have no idea. ये बाउंसर था यार. Bhopal, any plan center? No, I don't think so. Bhopal, Chennai center will come. Yes, so the next center that will come is Chennai. US OTA is full. US is full of OTA centers. Omkar. Yeah, Divya Mumbai I'm taking next month, but unfortunately I don't think you'll get a seat there. It's full. 30 waiting list is what I have been told. एनी प्लान टू कम टू अहमदाबाद? अरे आप अहमदाबाद वाले लोग है ना, मुझे बुलाते ही नहीं है। मुझे छोड़ के सबको बुलाते हैं, इसलिए लोग भेजते नहीं मुझे। सुशीला, next year I'm coming to US for vacation, don't worry. Which place do you live in US? California. I'll be there, don't worry. It's one of my favorite places in the US. When will your retake at Mumbai classroom? I am taking a batch in March, Arun, in Mumbai classroom session. Chandra, what important field? Arun, have you enrolled for that class? No, you won't get now, don't worry. Don't even bother. It's not a retake batch, it's a fresh batch, but then there are certain seats kept reserved for retake students. Percentage change in the option chain. Why do you need percentage change on why do you need it? You don't need percentage. I never felt the need for percentage change. Rajit, no, for options or for core strategy? Option no. Core, I don't do online. I only do options online. Yes, Amit, I do take core strategy. Okay, fresh class means there are people who don't know anything in that class. March. Yes, Amit, I'm on LinkedIn. Volume is in contracts and OI is in net shares. Yes, Chandrasekhar. Yes, Amit. In retake, it's just like I think retake class is a 4 day class wherein uh, they just briefly cover the core strategy and then most of it is trading only. Any combo? I don't know, man. So, in fact, a lot of Bangalore students had also requested. I don't know what happened to that request. Is there a way to pull all scripts falling in say section 1, 2? Yes, Pavana, there is again a feature here, uh, which is again thanks to yours truly that feature is there. But though I did not like that feature to be added in the tool, a lot of students will misuse it. I'll show that to you today. Don't worry. Okay, I have no idea then. All right. Any questions from yesterday? Oh, is it? You're still following up and still they haven't done it. Good that you told me this. Okay, all right. Q&A. All right. Refresh all 6 strategies first. Sir, one point when historic volatility Histo volatility then important. I didn't get your question, Ramesh sir. Yeah, so we use implied volatility. Historic volatility only gives us the range. So let me just show it to you. Hold on. Okay. Yes, Rajiv, I'll do that. Don't worry. So you see these bands, Ramesh, do you see these bands here? Okay, let me. Maybe it is more difficult. Okay, now. No, 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 no. HV is not mean. Okay, so what HV tells us is HV tells us historically what the stock has been capable of doing, the fastest and the slowest. That is what HV tells us. The movement, the speed with which the stock keeps moving, the fastest in the last 1 year that it has moved, and the slowest the stock it has moved. And when you know these two values, you just divide that into 5 range. So that becomes your gauge. And then you see where is your current implied volatility with respect to that range. If it is on the higher side, options are inflated. If it is on the lower side, options are deflated. Correct, Rahul. All right. One moment, guys. Give me one moment. All right. While buying, IV tells the deviation. IV no. IV tells us, Ashish, what is that people are expecting right now. Yeah, so IV will tell you the deviation from the standard deviation, whether it is within the standard deviation or whether it is away from the standard deviation, out of the standard deviation. While buying puts or selling the call options, which OTM strike should be picked up? It's the nearest to ATM or deep out of the no, not deep out of the money. Deep out of the money, Chandra, you will not get that kind of premium because farther away from the current market price, lesser the time value, lesser the time value, lesser the premium. So it has to be just the strike, whichever is there about the distal line of the supply zone that is being considered. Okay. Any other questions? Then I'll review the 6 strategies. No, Prasanna. There's no significance. Now remember one thing. A lot of you have been following something called as demand zone along with open interest, or wherever there is high open interest, price will not go uh, beyond that. Do not think like that. Now imagine you are a investor. To hedge your portfolio, what are you going to do? To hedge your portfolio, what are you going to do? No, buy puts, not sell. Buy puts. Hedging is only buying puts. Prasanna, Deepa, Shashank, you cannot sell calls. When an investor hedges, he only hedges using a put option. Yeah, so he'll only buy puts. So for example, when you take medical insurance, do you really expect to have a medical claim, or do you expect, okay, I don't want to have a medical expense? So similarly, the investors will buy put options because in case something untoward happens, they are protected. If suddenly the market drops down, they are protected. Now, that is not for options trading. That is primarily for hedging. They can. Why do they want to sell options? I mean, it depends on the investor, right? Usually, selling of options is done by options trader and not investors. Why do they want to sell puts? Selling puts is bullish. Yeah, so that's fine, because if you are expecting a huge drop from a higher time frame supply, that's when you want to do that. For hedging is not by selling options. Hedging is by buying options. That is that to put option. Collateral. No, I have not heard this news. Collateral. So it's primarily what that might be is like you need margins when you are selling options. So if you don't have margin, even if you have the stock in your demat account, you are allowed to sell options. They won't need margin. Why? Because it is against the position that you hold. You see, hedging is done primarily to understand, to make sure that your wealth is protected, does not go down. So details of hedging is covered in Proactive Investor. I think if you guys have bought the package, most of you will go through Proactive Investor course also, where this will be spoken about. So one point you said regarding Nifty to have in 100 strike. So when current market price is 165, strike price is 100 and 200, then intrinsic value will become less. So there will be no intrinsic value for 200, and for 100 the intrinsic value will be 65. Ramesh. Mr. Suresh, which I think you've taken the total solution, right? So that will have Proactive Investor. Yeah, so don't look at costly like that. No, delta can never be greater than 1. Income solution does not have Proactive Investor. Correct. Delta can never be greater than 1. TT showing value greater than for Nifty, and Bank Nifty script showing greater than. Where? Where are you seeing that, Chandra? Yes, Prasanna. In TT Greeks, not possible. It won't show you. Where TT Greeks you're seeing? So some platforms will put delta as 100 to 25 to 100, 0 to 100, which is nothing but 0 to 1. So 10 means zero point 0.1, 25 means 0.25. Which the okay, hold on, right. Are you looking at the tools, the options calculator? Is this a tool that you're looking at, Chandra? Okay, then I don't know which one you're looking at. All right. Okay, that's in the other one. Because puts give you the right to sell, right? So investors will always want a right to sell in case something else happens. Which other stock will give you right to sell? Okay, that is not. I have not downloaded the new one. All right, so let's quickly. Yes, today you will know how to use Options Oracle. All right, let me go quickly review. Yeah, it is okay. Okay, Chandra, it is showing you net deltas, total deltas. Yeah, Kapil, according to your view means, I mean, if markets are trading in supply, they will go ahead and buy the put options. Yeah. So when they're trading in supply, people will rush to buy put options. Okay, Chandra, don't worry about the tools that will be taken care of in XLTs. Right now, we are going to look at a different tool which is freely available. Focus on that tool as of now. So as I said, deltas could be it won't exceed 100 then. Yeah, they might be tracking it 0 to 100 like the US. That's possible. All right, just quickly take a look at this. Script is in an uptrend and trading in the demand zone. IV is in section 1. When IV is in section 1, the probability of IV moving to section 3 is higher than remaining going back. Long call is done in demand zone. It's a debit strategy and a bullish strategy. The risk is limited to the amount of premium that you've paid. The reward is unlimited to the amount of as long as the stock goes down. Break even is strike price plus premium. Delta is positive. Theta is negative. Why is delta positive? Because it's a bullish strategy and positively correlated option. Theta is negative. Why is theta negative? Yeah, no, because you buyer of options, right? Since you're buyer of options, theta will always be negative, isn't it? Correct. And vega is positive. Why is vega positive and high? Because it's in section 1. Absolutely correct. No, there is no range for Vega. There is only range for Delta. Remember now as an options trader, okay, as an options trader, especially as a directional options trader, so you want to do directional strategies, your initial focus is always going to be on Delta, because Delta is the one on whom you rely to pay, because that's the only thing that you can control, right, using supply and demand. Whereas volatility gains are not in your hands. The only thing that you can expect for volatility is we have a range. So if it is very deflated, volatility will tend to move up. If it is very inflated, volatility will tend to move down. Yeah, for a buyer of an options, increase in volatility will definitely be beneficial. All right. How is the strategy implemented? At demand zone, once the stock hits the demand zone, buy an in the money or at the money or in the money call option. The parameters are 90 days to expiry. Why? Because since you're buying options, you need to tame time decay impact and also increase your volatility exposure, isn't it? Okay. Strike selection. So parameters is minimum 90 days to expiry and 0.25 deltas, and we need 0.25 minimum 0.25 deltas so that at least 25% of the shares should start participating immediately in the move as the underlying starts moving. Okay. And strike selection is at the money or below AOB, the distal line of the demand zone is being used for entry. Maintenance close if the target or stop is met based on the script price. Remember, your entry, stop, and target, everything is based on the script price and nothing. There is nothing that you do based on options pricing. Close if the target or stop is met. Roll if expiry is less than 60 days. Why do we roll it over if expiry for expiry to be less than 60 days? Because theta starts getting active. Correct. No, Prasanna. Unless and until you get a 90 days out expiry option, you won't be doing it. You have to have at least 90 days expiry. No action. See, if you follow all the rules, Srikant, and apply all the rules and take the strategies accordingly, right? You will never come into this situation. Unless the only time when this will happen is the stock has not moved from the demand zone and is hovering around there. And the option we are getting closer to expiry. Right? Yes, the longer expiry will take care of that. So if you buy 90 days out, you won't get into this problem, because let's say in the first month the stock did not move at all out of the demand zone, then you anyways will have to roll it over. When you roll it over, you're making sure that whatever the condition that you're mentioning, there is a remote chance for that to happen. Unless the stock falls, you will not have the change in your options premium. So this is the example. That's a demand zone 107 to 100.80 and target is 132.50. Once the stock comes into the demand zone, just buy the 100 call option because volatility is in section 1 and ensure that delta is minimum 0.25. Whatever values of theta and vega you are going to get for single leg strategies are going to be the optimum values. Alright, is this strategy clear now? Similarly, long put. Now, do you want me to cover long put or this is the same, just that it is in the supply zone? Each and every rule is the same. It's just that instead of demand zone, we're talking about supply zone. Instead of call, we're going to talk about put. All the rules, all the trade management rules, everything is going to be the same. Option, no. Venkatesh, offset is used only when volatility is in section 2, 3, 4. They are never used in section 1 and 5. But I will tell you some rules for you towards the end as to what all you should do. So you can add offsets in section 5 to protect your position, but not in section 1. Okay. So is this clear? The put also is nothing but bearish section 1, limited risk, unlimited reward, break even is strike minus premium, delta is negative because it's a negatively correlated option put, theta is negative because you are a buyer of the put option, and vega is high and positive because you are trading in volatility section 1. Similarly, again, at or above supply, you buy the put option, which will be slightly in the money or at the money, minimum 90 days to expiry and minus 0.25 delta, and strike selection at the money or above supply distal line of the supply zone being used. Close if target or stop is met, rollover if expiry is less than 60 days, and evolve if IV moves to a different volatility section. So that's and similarly, this is the example. That's the supply zone. So once the stock comes to that supply zone, because IV is in section 1, you will go and buy a put option at or above. So 58.63. Above that, the next strike that is available is 5900. So choose that strike. And once it hits 5805.75, that is the proximal line of the supply zone, that's when you will go and buy the 5900 put option. Okay. And ensure that delta is minimum. How much is delta? 0.25 minus 0.25, and vega and theta are the values that you will get automatically from the options. So that's long call, long put. Let me just quickly go through. Yes, in Trade Tiger manually, other platforms will provide you. Yes, Anand, if you let me finish. Short put is a bullish strategy and a credit strategy, remember. Yeah, so if your underlying trade is set and forget, your options trade will also be set and forget most of the times. Prasanna. The options oracle will help you approximately find a value of options during that when it comes to your area of interest. You'll come to know today. This is a credit and a bullish strategy. Potential benefit from implied volatility reverting to the mean after an extreme rise while theta. So the condition is that when it hits the demand zone, instead of IV being in section 1 is in section 5, which is very inflated. And inflated options, do we buy or sell? Sell. And the risk is unlimited, the reward is limited to the amount of premium that you have received. Break even is strike price minus premium. Delta will be positive. Why? Because it's a bullish strategy. Theta will be positive. Why? Because we have sold options. And Vega will be negative because any increase in implied volatility is going to hurt our position. All right, that's how the graph looks like. Limited reward and unlimited risk. Action, sell and out of the money. So basically the same demand zone, just when the volatility shifts from 1 to 5, the strike price is going to be the same, just that instead of call it will be put now. Okay, parameters here will be 60 days or less of minimum 0.25 delta. Remember, bullish strategies will have positive deltas. Strike selection at the money or below the demand zone being used for entry. Close if target or stop is met based on the script price. Close if short unit is trading at 10% of the premium received. So if when you sold the put option and you received 25, let's say 40 rupees, if you received 40 rupees, so you will square off your put in profit when the value becomes 4. Don't wait for it to become 0. All right. So this is the same demand zone that was being used in the first example. Now instead of buying the 100 call option, we are selling the 100 put option. Why are we selling the 100 put option? Because it's in section 5. All options are inflated. And you have to make sure that the delta is minimum 0.25 positive because it's a bullish strategy, and theta and vega whatever you get from the options pricing. Similarly, the short call is credit and bearish. This is done in supply zone. So potential benefit from IV reverting to the mean after an extreme rise while receiving theta. Second point about square off. So I'll explain it here, Anand, in this strategy. In periods of panic, market participants often buy options for more than what they are worth, and that is to your advantage. Okay, risk is unlimited because it's a credit strategy. Reward is limited to the amount of premium that you have received. Theta is positive and vega is high and negative. Why? Because any increase in implied volatility is going to hurt your short position, and that's how the graph looks. So as once the stock hits your supply zone, sell an out of the money call option. The parameters are 60 days minimum for expiry, maximum for expiry. So start with the front month. If the front month does not provide you enough reward to risk, then go to the next month. Okay, but don't go to the far month. And strike selection is at or above the supply zone being used for entry. One question: we consider the lower end of zone 1, say, or upper end of zone 1 for a. No, no. So usually it's the middle of the zone. Between section 1 and 2 lines, if the IV to IV value should be in between that. That's it. That's section 1 for us. Yes, now the IVs will start moving up slowly. Yeah, so you have to be careful. So don't do naked options during this election time. It should always be the spread strategies. Yes, you will get this. So in your so this is how you will be having it in your it is there in your student lobby. So all everything is provided here in a summary. Look at that. All these are all bullish strategies, directional bullish strategies. Long call, section 1. Section 2, bull call spread. Section 3 is taken out. Section 4 is bull put spread. Section 5 is short put. Okay. The characteristics, the graph, the setup, the action, and the maintenance. Everything is provided you in detail. So this is what you need to take a color print and put it on your computer, on your desk. All right, Ashish. Okay. Close if target or stop is met based on the script price. Close if short unit is trading at 10% or 10% of the options premium. So, Anand, the square of is now if you when you sell options you receive premium, and let's say you receive 30 rupees premium. So as the underlying moves in your favor, will this start reducing, Anand? So the moment it becomes 3 rupees, which is 10% of the premium received, you square off. That means you take 27 rupees and go home. You don't wait for the entire 30 rupees. Alright? Okay, perfect. And evolve if IV moves to a different volatility section. The same example of 5900 put option. Now because IV is in section 5, instead of buying the put option, you will sell the call option. That's it. Because IV is in section 5 and ensure that I have a minimum delta of minus 0.25. That's it. So that completes these four strategies of the single leg strategies. I'll quickly take a look at the multi leg strategies. Okay. So now the same demand zone. Okay. When stock comes to a particular demand zone, the implied volatility section can be anything. It is not something that you can decide that demand में आया मतलब section 1, supply में आया मतलब section 5. ये अपने हाथ में नहीं है. This is based on people's expectation. Remember that, isn't it? Yes or no? And which keeps on moving based on their perception, and how their perception changes. How do people's perception change? News, whatever information they have, whatever information they process, all that. Okay, events, yeah. So based on that, their perception keeps on changing. Now, in the same demand zone, instead of being in section 1, the IV is in section 2. Now, what is the issue of IV being in section 2 if you just buy a call option? IV can come back to section 1, and when IV comes back to section 1, what happens to your options premium which you had bought? Loss of premium, absolutely. Your premium will reduce, thereby giving. And imagine this. Okay, let me just show you this. Okay, okay, imagine this, that when the stock comes to your demand zone, it is in section 2. All right, When the stock comes to your demand zone, it is in section 2, and instead of doing a bull call spread, you do a simple call buy. And now the stock starts going deeper into your demand zone, and at the same time the IV also starts reducing. At the same time, IV also starts reducing, and the stock is also going towards your stop loss. What is the issue that you're going to face? You will have higher losses, because you will lose premium by virtue of delta going against you and by virtue of volatility also going against you. So both this, so there is a tendency that you might actually lose more than what you anticipated. Right? And that's why in section 2 you can't risk only buying call. Okay, from a practical standpoint, I can allow you to buy just at the edge of section 2. If the stock is coming into the demand zone, you can go ahead and buy, but it has to be in a strong trending stock, not in the current market conditions where then when they are trending down or most of the stocks are in the sideways movement. And at least 60 days to expiry. 30 days, i I don't even have the hisab of the amount of money that I have lost by buying options. इसलिए जब कोई बोलता है ऑप्शंस खरीदो तो मेरे दिमाग में घंटी बजती है, मेरे लॉसेस कितने हुए थे करके। प्रीमियम हमेशा डोनेट किया है। So that's why you see me being so strict with the rules. Why? Because I know whenever I have broken rules, I have lost money. And the only thing was, it tells you when you break rules, you don't lose money. So by doing the same thing, I was expecting different results, which is not possible. That's how foolish I was. That more than that, it was like trying to break OTA's rules. All right. So potential benefit, yes, Anand. Sometimes, yes, Ashish, definitely I do make mistakes. This is psychology issue, not my knowledge issue. It's a psychology issue, and you have to constantly work on your psychology. So it is not sometimes that you break rules. Very, very rarely I will break rules, especially in options. Yeah, sometimes I get aggressive in core strategy, futures trade, stock trade. I get aggressive. That aggressiveness sometimes hits me. Yeah, mistake is different. So mistakes are sometimes you miss out on, let's say, in a core strategy, I miss out on the overall trend. What is market? So sometimes you expect that अगर यहाँ से turn होएगा because demand zone में. So everything is based on the rules only. It's just that sometimes it's like 19-20. Confirmation trade लूँ या aggressive trade लूँ. Those kind of mistakes I make. Only in Nifty, Divya. Only in Nifty. Yes, you get enough options trades. Sony. Yeah, percentage of mistakes are less, no doubt. Yeah, so I don't have that carelessness now. No, it's not like that, Prem Sinha. It's not that Nifty rarely comes to section. And why you bothered about section 1 only? You have to understand the beauty of selling options. The problem is nobody wants to sell options here. The beauty of selling options is constant influx of money coming into your account. Remember that. And till date, the amount of money that I have made by selling options is far, far, far more than whatever I have made in buying options or or debit strategies. Far. I mean, very rarely I have made money in buying bullish strategies. Sorry, debit strategies. So you have a stop loss, Suresh, right? So if you buy a futures contract, Sureshji, if you buy a futures contract, don't you think you have unlimited risk? Yes, Anil, that makes sense. Margin is as good as futures. Yeah, primarily stocks, I sell options. Sushila. Prasanna, it is not based on equivalent strategies for WIT. It is based on, it is primarily based on the volatility analysis. You can't decide that. No, no, no. That is what you think. So, now, have you guys ever seen the inflation tool before this? So how can you say Nifty is always in section 3, 4? It never rarely comes to section 1. On what basis are you guys saying that? बस मन किया बोल दिया. You see this? This is all section 1. Yes, Shrikant, absolutely correct. It's all about return on investment. Look at this. This is all section 1. In fact, I don't want stocks IV to be in section 1. I want Nifty Bank Nifty to be in section 1 because I can trade them. In stocks, it becomes difficult to trade them because of lack of liquidity in far months. Hey, Anand, once we finish strategies, we are going to take a look at that, right? So the risk is limited in a bull call spread in section 2. Reward is also limited. Break even is anchor strike plus premium because we are using a call option. Delta is positive because it's a debit trade. Theta is negative because we are buying options, and Vega is positive because we are in volatility section 2. That's how the graph looks like. So what is the strategy? The same anchor will be bought here plus call, but at the same time you're going to sell another offset. So what this offset does is, in case implied volatility drops, it is going to reduce premium from your plus C. Similarly, it is going to reduce the premium from minus C. So that is how it offsets. So you know primarily why we do this, so that in case it goes for a stop, in case, remember I told you in section 2, if you buy a call option and the stock goes and volatility drops down, volatility drops down as well as the premium, it will be higher in percentage terms. But with this, whatever you lose in plus C, you're going to this is going to compensate for that. So your losses are curtailed. That's how you mitigate it. Correct. Okay. Again, the parameters are 90 days minimum for expiry with point plus 0.25 delta. At or below the demand zone, you buy your anchor. At or above the supply zone, you sell your offset. Maintenance close if target or stop is met based on the script price. Rollover if expiry is less than 60 days. And evolve if IB moves to a different volatility section. No, 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 no. Chandrasekhar, look at this, right? If minus C was going to be 60 days, it would have been mentioned here. Yes, both at the same time. First buy the call option, then sell the call option. And both are going to be 90 days. You are not in supply. This minus C, Rameshji, is not for supply zone. This minus C is just to offset the bad characteristics of this anchor unit. Supply zone is going to be a target. I've started hating this word hedging now. Correct. Minus C is at or above at or above AOA, not AOB, Rajiv. Yeah, correct. Whatever is your target, right? Above that, the strike price above that target. Yes, Shrikant, you're absolutely right. That's the only drawback we have in India as of now. That's because of lack of technology to have spread trades, go as spread trades. So in our since our exchanges do not provide that, what we have is everything goes as a single leg. That's why the margin requirement is higher. But still, you end up making more than 10% return. A little. It has to be roundabout. If you have a dollar account in the US, you can. You cannot transfer money from India to US for trading. You can transfer money from India to US account, trading account, investment account. That is when you want to buy shares, but not allowed for trading. So if you have a family member or some friends or your own account which has dollars, then you are allowed to do it. You just need to show the source of fund is not from India. Yeah, Rahul, because they are removed. Section 3 strategies are removed. Yes, Ashish. It's only as an FPI you can trade. Okay. So in this close if target or no. There are different strategies for section 3, Rahul. Different strategies. So remember, directional in section 3 are not, there are no strategies. For directional movements, section 3, it's better to trade futures or synthetics, either of them. I'll show you later on why we have removed the strategies. Okay, why we have removed the strategies, I'll show it to you later on. It's logical. There is a logical reason for removing those strategies from these course materials. It has been removed even by the US. Yeah, from Excel it will be removed very soon. Excel topics are yet to be uh, changed. That is in process right now. No, Rajit, I don't trade synthetics. I don't trade synthetics. I don't trade ratio spreads. I don't trade call butterfly, put butterfly because They don't make sense, Divya. Instead of trading synthetics, I will trade futures. Alright. Close if target or stop is met based on the script price. Yeah, simultaneously in sense, first buy the anchor, then go and execute the offset. Rollover if expiration is less than 60 days and evolve if IV. In this case, you don't evolve. In case of section 2 strategies, you do not evolve. Yeah, of course, same day, Rameshji. Same time also, one after the other. Yeah, only from section 1 to section 2 you evolve. From section 2 to section 3 you don't evolve. And similarly, you evolve from section 5 to section 4, don't evolve from section 4 to section 3. So once you go through the position evolution chapter, which I have taken in XLT, you'll be much clearer on this, the evolution process. All right. Okay. Similarly, the same example. Now here you'll buy the 100 call option and at the same time sell at or above supply the call option to compensate for the bad Greek characteristics, and the net Greeks are a result of that whole thing. So the call, the anchor has a delta of 0.6856 and the offset has a delta of 0.2189 and the offset is what you're selling. So the net delta is this delta minus this delta, which will make it 0.47, and theta vega are this. So primarily you do this to manage vega and then theta. Now this is the other one, bear put spread, debit and bearish. Just that this is to be done in section 2 and supply zone, that was in section 2 and demand zone. Potential benefit from IV reverting to the mean. Offset provides protection in case implied value does not revert to the mean and keeps dropping. Risk limited to the amount of premium that you have paid. Reward is also limited. Why? Because you have an offset unit. Since it's a put based strategy, break even is anchor strike minus premium. Delta is negative because it's bearish. Theta is negative because you're buying options. Vega is positive but smaller because we are in volatility section 2. That's how the graph looks like. So in section 1 supply zone, you would normally buy the put option. In section 2 also you will do the same thing. You will buy the put option here first, and at the same time once you do the buy the put option, immediately you'll go and sell the put option below your demand zone where you're going to cover your position. Parameters, both options 90 days expiry, okay, and minimum minus 0.25 delta. Anchor at or above the supply zone, offset at or below the demand zone. Close if target or stop is met based on the script price. Roll if expiration is less than 60 days, and evolve if IV moves to a different volatility section. In this case, don't do evolution. The same example here, you are buying put in section 1, but because it is in section 2, along with that you will add an offset unit. Anguti pehna deedar. Yes, and closing is also both simultaneously. So first close the anchor, then close the offset. Yes, Rameshji. First close the anchor, then close the offset. All right. Are these 6 strategies clear now? We have summarized everything for these 6 strategies. Quickly, what I'll do is, we have about 10 minutes for the breakfast break. No, no, two orders. They are individual orders, Prasanna. You can't do it as two orders. So what you have to do is, let's say if you want to do add script, let's say you want to place a bull call spread in Nifty. Expiry, let's say I'll take far month calls. Let's say 10,700 is what I want to be a buyer when it hits a demand zone. So only okay, let's say I take the June expiry 1927. Okay, and let's say my offset unit is going to be 11,200. Okay, so this is my bear call spread. Now bull call spread. I first execute this. Let's say I'm going to be a buyer of this. I buy this whatever price. Okay, once this gets this gets executed, I place this order. I then go and place this order. That's it. That clear, everyone? Order placement. Yeah, it's so simple. I mean, these are all operational issues. You can ask your broker and he will help you with that. Now, just take a look at the graph. Okay. Now, this is the call ratio spread graph. You can either place both orders one after the other and not wait for the anchor to get executed, or you wait for the anchor to get executed, Deepa. It's left to you. I generally place the offset unit. If I am going to be in front of the computer, I'll place the offset unit order afterwards. If I'm not, then I'll place both together. What is OI spread, Girish? What does this graph tell you? That's a call butterfly. Tell me, what does this graph? Absolutely. So Anand, you are right. Low profit in all scenarios. See, the profit is only this much. This triangle, right? This is the only profit, and the maximum profit is going to be only when the stock closes at expiry at this point, isn't it? That's where the maximum profit is. And now, is this a bullish strategy? Now see the beauty of this. Okay, why we got this removed? If the stock goes down, you have limited risk. You see this? Limited risk, isn't it? So if you guys want to keep an eye on the markets, I'll give you a break now, and I won't explain you the difference. Even I enjoy looking at the markets. I have missed markets for this whole week. I will not. You have to tell me, what is it? Answer my question. What do you make out of this graph? Absolutely, Anil. Unlimited risk when the stock goes in your favor, isn't it? It's a bullish strategy. Bullish means you expect the underlying to move up. Correct? And it penalizes you for being right in the direction. So what this strategy expects is the breakout or the fast move is not going to happen today. Who can tell you that the fast move is not going to happen today? No, nobody can tell you that. Nobody can tell you that. How can anybody tell you आज निफ्टी 10% 5% ऊपर जाएगा? क्या आप कोई बता सकता है आपको? Nobody. Reward is only when it remains within a range before that expiry. Only, and if before that expiry, if that stock just shoots, you are going to make huge losses. Now, will this make sense to you? Instead, I shouldn't do a futures contract here. So you're being penalized for being right in the direction. Entry point is again going to be a demand zone only. This is how the strategy is. This is just an adaptation of the bull call spread. If you see, bull call spread is what? Plus C and minus C, right? Here you add two C's. That's why it's called ratio. The ratio is 1:2. So one short call will offset the plus call bad characteristics in case volatility drops. But in case the stock goes beyond your target, instead of paying you, it will penalize you. Absolutely, Prem. But we can. What if it comes here and tomorrow it gaps up 5%, Prem? How are you going to manage this? And stop loss जब होगा तो loss बड़ा होगा. No, I will not trade Asian Paints. Rather than do, if it is in a range for 20 days, right? Do a non-directional strategy rather than this directional strategy, which makes no sense. Yeah, it's not optional. The options are not liquid either. Yeah, many strategies. We have to cover that. Yes, because if the stock goes beyond that, then we'll start making losses, Rahul, isn't it? That's what this graph means, right? Unlimited losses when the stock moves in your favor. No, futures is not in this asset class, and I don't think I will have the time to do that. And to mitigate that risk, you have another strategy called as call butterfly. The same strategy, plus C minus 2C, you go and add another plus C and look at the graph. Again, the same thing is just that you're capping your losses on the upside. Now you understand why this is removed from the syllabus. I have not even traded this strategy once. So a lot of people think that okay, we can make few thousand rupees in this trade, but then if at expiry it is not there in the range, it is down, you're going to lose much more than those few thousand rupees. Ashish, you had asked me yesterday about these strategies, right? So these are the reasons why we have removed these. All right, guys, let's break for breakfast. Yes, both ratios, spreads and butterflies. Everything is called butterflies. Everything is removed. Only thing is there is an adaptation of this butterfly strategy for non-directional sideways market. That is covered in XLT, and that is a very good strategy. Only in sideways. if there is a huge difference in option price in option chain when you explain at that time? No, no, there's nothing like that. I don't know what I said. Uh, the spread. Okay, okay. The call, the bid and ask. The bid and ask should not be very, very big, Girish. Our rule says that if your option is priced less than 60 rupees, the maximum bid and ask spread that you can have is 10% of that option price, which is 6 rupees. So since let's say this one, the 10850 or the 10900 is trading below 60 rupees, right? 28.8 and 28.9. The spread can be maximum 2.83 rupees, 10% of that premium, not more. If it is more, then you can't trade that. Alright, that's it. Okay, now guys, all of you exit the room and join back at 10:30. Then we'll go with the remaining strategies. And by 11:30, I need to start RR calculations. I'll see you guys at 10:30.